I totally believe that. It feels that that's directionally the right way, is to think that the smart contracts will be much larger than Bitcoin over time.
And I think it's not to say that Bitcoin in and of itself won't be the largest asset class, just like gold, right?
Correct.
You know, gold is 27 trillion, but the stock market is 128 trillion. And when you start adding essentially, you know, private markets on top of it, you have over 200 trillion. So that is roughly what informs our thinking as to where Bitcoin as the form of digital gold will be relative to where everything is in terms of the altcoin space, which is what we use, right? And altcoins isn't specifically just a meme coin or, you know, a utility token in itself. It could be RWAs, you know, it could be sort of other uses that you build.
Crypto markets balance institutional stability with retail emotion, where disciplined investors temper volatility and younger participants chasing quick gains intensify it. Yat Siu emphasizes the long-term perspective in crypto, pointing out that early cycles and market swings often trap participants in short-term thinking. He highlights that despite volatility and repeated market shocks such as FTX or Terra Luna, the broader fundamentals of Bitcoin and Ethereum continue to strengthen. Yat Siu also notes the psychological impact of political shifts, such as the Trump administration, which created exuberance among some participants while exposing retail traders to repeated losses. He underscores that cultural beliefs, like the 4-year cycle, influence behavior, but increasing institutional involvement is gradually softening these self-fulfilling patterns, leading to a more stable market. Raoul focuses on the societal and generational pressures driving crypto demand. He explains that younger people, facing barriers like unaffordable housing and limited traditional investment opportunities, see crypto as a potential solution to wealth inequality. This creates highly emotional expectations for massive, rapid gains, turning the market into a psychological battleground where impatience and desire for outsized returns often outweigh measured strategies. Powell suggests that the intense emotional demand among new entrants contributes to volatility and short-term behavior that may not align with long-term fundamentals. Their perspectives complement each other. Yat Siu highlights the structural and cyclical aspects of the crypto market and the influence of institutional versus retail participants, while Raoul underscores the socioeconomic pressures and emotional behavior driving retail demand. Both point to human psychology as a central factor in market dynamics, whether through self-fulfilling cycles or impatience born from wealth inequality. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Well, I mean, first of all, you know, it depends what lens you take, but I mean, we've been on this journey for a little while. You probably longer than myself. And I remember back in the day when we actually got into the whole crypto scene, you know, first with NFTs, but generally in the space. This was 2018 and 2019. I mean, Bitcoin was $3,000, right? And everyone was calling it the end of the world. Ethereum was actually trading below 100. It was $80. And I keep telling people, guys, just macro and zoom out a little bit and just take a look.
People find it so hard to do that because they're obsessed by cycles and they don't see the big picture.
And there are cycles, sure. However, just zoom out, and unless you're trading, unless you sort of want to sort of do the day trading thing or something. But if you're just taking a macro view, then it's okay, right? And there'll be corrections and stuff, and there'll be cycles. But broadly, it's going in the right direction because, hey, guess where the world is going and what's important and all that kind of thing. Just consider the fundamentals, right? And that's exactly what happened. And I was just posting something, I think just like a couple of days ago, where I said the sort of greed and fear index, according to CoinMarketCap, is actually lower today than it was post FTX and Terra Luna, right? Now, just picture that. And I'm like, guys, Bitcoin was, all the way down to 16,000, averaging around, let's call it, mid 20s, right? And Ethereum was hovering around 1,000. And the sort of fear index was like in the 30s. And right now it's in the mid to low teens. And like, what is going on, guys? Like this, just generally just like sort of, it doesn't make sense per se. But it just also shows how people are just, in some ways, so I think a little bit fragile. Because I think I think to me what's actually happened is it's quite psychological. Because it's one thing, I would argue that had Trump not been elected, and it wouldn't have been, we would still have been in the quasi-Gensler era of crypto, and there would be ETFs and so on. Everyone would be much more measured in their assumptions of where the market would go, right? But when Trump was elected, there was really exuberance, especially in crypto. It's like, oh my goodness, crypto's is gonna be everywhere. The Trump and family, they love crypto, so it's all good, right? And so everyone basically just expected it just to moon all the way, and not realizing that, I mean, in many ways, sure, Trump and the Trump family are obviously pro-crypto, but they have other things on their agenda. That's not just crypto, right? And so I think the scoreboard for crypto under Trump has been 50-50. And I think not because it's 50-50 in a bad way. It's just that, it's been great for institutions in a way, right? For Bitcoin and Ethereum and the majors. And it's been terrible for sort of certainly meme coins and altcoins and other areas in many cases, because, it's really been the sort of retail guys who, the existing retail guys, because new retail didn't really join, right? Existing retail guys who've been wrecked not once, not twice, but probably 4 or 5 times this cycle. And I think the damage is this feeling of sort of, but it's okay because we have Trump, and it's positive because it's older. So instead of being a little bit measured around, actually, this is just a different way of how the market's evolving. We still have to manage our risk. We still have to be cautious. Just because someone's pro, it doesn't mean there's not possibly sort of danger ahead in some form or fashion. Whereas before, I think we were hyper vigilant for good reason, because literally there was an enemy at the gate the whole time, right? So you had to sort of watch out, and so you're much more careful. And ironically, if you think about the liquidations that's taken place this year, the damage and carnage that's taken place, particularly with, basically things like perps and futures and so on, and just the leverage that's been happening, in comparison to 23, 24, 25 compared to 25, 23 and 24, pretty tame, right? So I think it's this mixture of people just like so excited and just throwing their, let's call it, risk strategies out the window, because they really thought under this regime things were going to be great, and they were great for some, but not great for others. Again, so I think that's kind of what's happened, and so the notion of what's happening in market is amplified. I also think there's a little bit of this sort of, I call it sort of this sort of religious tradition of the 4-year cycle, right? And as time evolves, I mean, I forgot who I was talking to about this, but, at the end of the day, even though crypto, Bitcoin, it's mathematical and it's obviously, but the actual cycle itself isn't mathematical per se, because who cares about the halving? Because we're at like 20 million Bitcoin. Like, it's not, it makes no difference. Okay, right? Yeah. Like, seriously, right? It's just not going to make a difference. However, the people who own crypto are the same people who owned crypto before, and they've become the whales, and they're an impact, and it's their religion, and it's their tradition. And so it's like a self-fulfilling prophecy where they go, okay, we're in the cycle, I got to start selling and then buy back later type of thing. And until more institutions are coming in, and I would say that the reason why it's not as, knock on wood, pronounced in comparison to where it might have been is because we do have institutions that are buying the assets that don't follow the same religious cycle because they're not of that world, right? It's not their tradition, right? So I think as we become more institutional and more broader accepted around the entire space, because remember, still a small number of the world owns this asset class in relative terms, then this whole 4-year cycle, this whole sort of nature is going to basically disappear and soften around the edges, because it's no longer held by the very people who actually sort of believe in that stuff and make it self-fulfilling, right? Because at the end of the day, we're still human.
And also what we see is as this kind of wealth dichotomy has emerged over time, particularly driven by the debasement of currency, it means that younger people don't have access to buying a house and don't have access to the same investment opportunities and that kind of thing. And it creates a sense of desperation that crypto is going to be the answer. And it probably is, but everybody wants it to happen immediately. So it becomes a highly emotional state where it kind of, they demand, it's kind of, it owes them 100x.
Yat Siu emphasizes how Bitcoin and the broader crypto market are influenced by market sensitivity and liquidity dynamics, where even minor news can trigger sharp price movements. Reduced liquidity from market makers amplifies these swings, yet such moments present opportunities to accumulate undervalued assets. He positions Bitcoin as the digital gold of this generation, while altcoins, smart contracts, and NFTs expand the ecosystem through practical applications and innovation. Yat Siu also underscores the cultural and social dimensions of value, comparing digital assets to modern art, where network effects and community significance create lasting Lindy effects that strengthen adoption and entrench value over time. Raoul focuses on specific market disruptions, such as the October events, where impaired market makers may have pulled back liquidity, contributing to background price movements without clear news catalysts. He highlights the long-term potential of smart contracts to surpass Bitcoin in scale, signaling broader evolution in the crypto ecosystem. Additionally, Pao stresses the role of digital art in creating new cultural niches, attracting participants, and generating Lindy effects that embed lasting value and influence within these communities, paralleling the mechanisms that underpin broader adoption in crypto markets. Let's get back to the interview.
It is fascinating. The other thing is clearly some damage was done in October.
Oh, for sure.
And, my read on it is market makers probably have impaired balance sheets from what happened because they got trapped in a lot of that because they couldn't actually buy the sell-off. They couldn't provide liquidity because they were frozen out of the APIs and all of that stuff. So they probably got impaired balance sheets, which means they're inclined to create less liquidity, less risk. And then maybe there's an unwind going on of somebody who got severely impaired over that period. And it feels like there's something going on in the background because there's no real news driving what's happening.
Well, I think outside of the sentiment and sort of small little sensitivities like, oh my goodness, Fed might not decrease the rates, and boom, suddenly it's like a big reaction, or job numbers are up, oh my goodness, right? I think there's definitely less liquidity, that's for sure. So there's less sort of cushion, shall we say, broadly speaking. Although from what we could tell, at least from our sort of market makers who we work with, I don't think market makers were quite as impaired, because really what they did was they just pulled liquidity as quickly as they could, right? And I think that's the reason why the bottom fell out, because they were like, okay, I'm out, I'm not here, like I'm not doing anything, I'm not catching anything, right? And so I think there's been a little bit of that. And in fact, for ourselves, actually, when that flash crash happened, we actually used it as a buying opportunity to sort of accumulate certain assets that we felt made sense as well, because they were ridiculously cheap, right?
I totally believe that. It feels that that's directionally the right way, is to think that the smart contracts will be much larger than Bitcoin over time.
And I think it's not to say that Bitcoin in and of itself won't be the largest asset class, just like gold,
Correct.
Right?
Correct.
Gold is 27 trillion, but the stock market is 128 trillion. And when you start adding essentially, private markets on top of it, you have over 200 trillion, right? So that is roughly what informs our thinking as to where Bitcoin, as the form of digital gold, will be relative to where everything is in terms of the altcoin space, which is what we use, right? And altcoins isn't specifically just a meme coin or, a utility token in itself. It could be RWAs, it could be sort of other uses that you build. You actually create sort of, assets that are commodities that now have use cases within sort of digital applications directly. There's a lot of innovation that can basically be built from and on top of that. And that's what we use, right? I mean, back in the NFT craze, people entered crypto not because of buying Bitcoin. They entered it because of playing a blockchain game, or basically buying an NFT or buying virtual land, right? And by the way, NFTs is still about $300 to $500 million of sales every month, right? It's just gone away from the traditional hype from before, where people who didn't know what they were doing basically were there. And I liken it a little bit like, if you're not in crypto, you wouldn't know about NFTs. But if you're in crypto, especially in the culture area, you would understand the value of them. And in some ways, owning a CryptoPunk has probably been a better levered bet on ETH than owning ETH itself, right?
That's right. And, I spend a lot of time in the digital art world, as you know, and it's bringing in all sorts of interesting people like Mickey. People don't really understand the scale of what's happening in the digital art world. And this is nice because you see these cultural niches becoming bigger, more entrenched, having bigger Lindy effects over time that most people aren't even aware of.
It's kind of like I tell people that it's the asset class of that generation, right? And so, like, for instance, I'll give an example that probably most of your audience might not appreciate because they probably don't live in China, right? Chinese modern art is massive.
Yeah.
Massive, massive, massive. But for someone who's not in China, it means nothing to them, right? But why is Chinese modern art so big? Because there's a lot of rich Chinese people now, right? Who have made their wealth. And what matters is essentially the social network effect that they have within China. Oh, you have this art. That means something to that community. It might not mean to someone in America, right? So it's hard to translate, right? But in China, it's worth a ton from a reputation standpoint. So you basically grew this into a multi-billion-dollar asset class, not just Western goods and culture, but basically now, so let's call it modern Chinese version of that. And it's the same with crypto. If you're a tourist or not even inside crypto, you look at these NFTs and you go, I don't know what that means. right? Because it's not your culture. And so it's strange to you that someone would buy something, basically, a picture that you could save, so to speak, right? But for people in China, it's everything, and I would argue that translates into all sorts of culture all over the world. There's American culture, whether it's a Warhol or maybe Picasso's, in Europe, or where it's very valuable there but not valuable elsewhere. It all has to do with what it means to your particular social groups and networks and Lindy effect, as you say, right? So yes, it's all the same, right? And if you understand that, then that's why you buy it.
Bitcoin and the broader crypto ecosystem are influenced by a complex interplay of market dynamics, liquidity constraints, and cultural factors. Periods of reduced liquidity often amplify price swings, yet these events can create strategic opportunities for accumulation and long-term positioning. While Bitcoin continues to serve as a form of digital gold, altcoins, smart contracts, and NFTs contribute to broader innovation, offering practical use cases and extending value beyond mere speculation. The true significance of these digital assets is closely linked to social networks, community engagement, and cultural context, where network effects and shared traditions generate lasting Lindy effects. Over time, these dynamics help entrench value, foster adoption, and gradually stabilize the market, as a growing base of participants, including institutions and culturally invested communities, shapes a more resilient and mature ecosystem. How will the interplay of liquidity, cultural adoption, and innovation in altcoins and NFTs influence Bitcoin's long-term market stability and value? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.